Welcome to CRE Fast 5 and today's review of CBRE's key macroeconomic assumptions. I'm Carly Iacono. Today, I'm going to walk you through a 30,000-foot view of the main things driving the current economic conditions. Let's start with GDP. CBRE's baseline expectation is for 3.5% year-over-year GDP growth in 2022, followed by 2% growth in 2023. This is a noticeable downgrade from the Q4 2021 outlook. Weaker global growth combined with higher commodity prices and interest rates are going to put downward pressure on U.S. growth. Next, on to the labor market. Very high demand for labor, which exceeds supply in some sectors, is expected to drive 3% job growth this year. Labor force participation remains low, especially for workers age 55 plus. Limited labor supply is poised to weigh on the pace of hiring in 2022. As for our new and least favorite buzzword, inflation, CBRE's baseline forecast expects inflation to peak during the summer of 2022 due to base effects and higher interest rates, but remain heightened through 2023. Most of the inflationary risks tilt towards higher prices as commodity prices are expected to remain elevated. The lingering inflation scenario, which differs from the baseline forecast, expects CPI to escalate through 2022 and finish 2023 at 3%. As for the consumer, poor sentiment indices have not been a good indicator of actual consumption in recent years. Presently, rising food and energy costs appear to be taxing the consumer, but a strong labor market is maintaining spending. Like many macro drivers, the risks to consumption are tilted towards the downside. Aside from the plausibility of higher commodity prices eroding core retail sales, weaker housing and equity prices are poised to weigh on consumer sentiment. Business sentiment is also being weighted down due to problematic supply chains and rising input prices. Although the demand side story remains positive, the reality of falling profit margins amid the rise of corporate cost of capital will likely depress activity. From the policy perspective, CBRE believes the Fed will hike rates at every meeting this year, and legislative stimulus should remain minimal for the foreseeable future. Finally, the overall financial conditions seem to be unfortunately deteriorating, as suggested by the higher interest rates, stricter lending terms, and changing asset values. However, on the positive side, the amount of dry powder set aside for future investment held by close-end real estate funds continues to be elevated at about $365 billion. When breaking down dry powder by investment strategy, opportunistic and value-add funds have the largest fraction, with $132.8 billion and $103.9 billion respectively. Over the past 5 years, commercial real estate has offered attractive risk-adjusted returns, especially within the industrial sector, which outperformed the S&P 500 by 4.4 percentage points with less volatility. The demand for hard assets in unpredictable times is evident. Investment flows into CRE nearly doubled in 2021 to $852 billion. So now is a time for you to monitor economic conditions closely and re-examine your investment strategy. Although this is a very volatile time, real estate fundamentals remain strong. Reach out to our team directly if you would like to discuss your individual holdings. That was CRE Fast 5. I'm Carly Iacono. I'll see you soon.